Trading on a margin can be the ultimate double-edged sword. Get it right and you're leveraging power. Get it wrong and your account basically won't survive. Today we're looking at margin trading, how it works, and the critical steps to avoid dreaded margin calls. Margin trading allows you to open positions larger than your account balance by borrowing funds from your broker. It's like collateral. Your margin covers potential losses. For example, if you're trading euro to the dollar with a 2% margin requirement, opening a position worth $100,000 only locks up 2% of your account. Sounds like a great deal. However, there is a catch. Margin trading is basically locked until you close the position. This is known as your used margin. The remaining funds is your free margin, determining if you can open new trades. In terms of equity, it's your account balance combined with floating profits or losses from your open trades. As the market price moves, your equity fluctuates in real time, and this is where it gets risky. If your equity falls to the margin call level, typically 100% of a used margin, you'll be restricted from opening new trades. Worse still, if your equity dips below your broker stop-out level, they'll start to close your positions to prevent deeper losses. To avoid this, smart risk management is key, using stop-loss orders, monitoring your free margin closely, and always staying prepared for volatile market conditions. Whilst market trading can be risky, it's a way to amplify your profits. Mastering it requires discipline, strategy, and a lot of respect for risk. If you found this breakdown helpful, hit the like button, subscribe, and stay tuned for more FTMO Academy content.